This is part 4 of topic 1, demand and supply, and we've got a very interesting application. So we're going to use the tools of demand and supply but apply them to interest rates in bond markets. So the first thing that we need to realise is that companies often need to raise money to finance investment spending, and there's basically 3 ways that companies can raise money. They can use equity markets, which is the issue of shares, or they can use short-term or long-term debt markets. Now it's really number 3 that relates to bond markets, and so we'll be looking at what I call long-term debt or bond markets, and we'll be looking at how the model of demand and supply can be used to talk sensibly about how interest rates move in long-term debt markets or bond markets. So moving along, the first thing we need to come to terms with is what a bond is. Well, when a company, including banks, when a company wants to borrow money to finance investment spending, then typically those companies will issue either equity or debt. And if they choose the debt option, then those companies will issue bonds. So what I've got here is an example of a $1 million bond that pays a $50,000 coupon payment, which is sort of a type of interest payment per annum. So right down the bottom I've got the yield there equals the coupon price divided by the price of the bond. So it's simply a matter of 50,000 divided by 1 million gives you the 5% bond yield. And on the left hand side I've drawn a demand and supply curve for loanable funds. So loanable funds are simply just funds that are available for lending for investment purposes. So with the coupon payment, that is actually fixed. So if you actually purchase a $1 million bond, that $50,000 coupon payment, you will receive that each year over the life of the bond. Now, these bonds, very often they will trade in secondary markets, and just like any financial asset, bond prices can go up or down. So if you buy your $1 million bond and then decide to sell it and the demand for bonds at that time is very high, then the market will pay you more than $1 million for your bond, or that is another investor will buy your bond from you for, say, more than $1 million. If that's the case, that investor still only gets $50,000 in terms of a yield. Sorry, in terms of a coupon payment. So if you take your $1 million bond that you're getting $50,000 a year coupon payment for and sell it into the secondary market, and that secondary investor spends or pays more than $1 million for that bond, then that person will be earning a yield of less than 5%. So the coupon payment in this equation on the right hand side of this slide down the bottom, the coupon payment is fixed, so when bond prices go up, the yield goes down. Similarly, if bond prices go down, the yield goes up. And whether bond prices are going up or down, whether you can sell your $1 million bond for more than $1 million or less than $1 million, really depends upon the demand and supply of bonds and or loanable funds, which we'll see is pretty much the same thing. So let's have a look at the size of the bond market. In 2010, so the column on the right hand side, the total value of financial assets in circulation was $212 trillion. Of that very final column, 54 trillion was stocks. Then we've got public debt, that is public bonds or government bonds. We've got $42 trillion worth of financial institution bonds, and then $10 trillion worth of non-financial corporate bonds. So the bond market in 2010 had a size of $93 trillion. So we're talking about a massive market here. Which bond markets were the largest? Well, looking at chart 1 here, we can see that the United States bond market was by far the largest market in the world. Roughly $25 trillion worth of bonds on issue in the United States, and those bonds are a mix of financial, corporate and government bonds. So that's $25 trillion worth of lending that has taken place through the issue of bonds. Moving on to the next slide, The next thing I need you to understand is that the market for loanable funds and the market for bonds is the flip side of the same thing. So they're basically very strongly related to each other. To motivate this, what I've got on the left-hand side is the bond market. So I've got $1 million bond, and I've got the initial demand curve D bonds, and I've got the initial supply curve S bonds. And the demand and supply for bonds are giving us a price of $1 million for, I'll say, a $1 million bond. On the right-hand side, I've got the money or loanable funds market. So on the left-hand side, I'm looking at a financial instrument. On the right-hand side, I'm looking at the money that relates to that financial instrument. So I've got on the right-hand side the demand for loanable funds, DLF, and the supply of loanable funds. And I've got the equilibrium interest rate of 5% right here. So what you can see is that I've set up the initial two equilibriums to reflect the financial asset I was talking about in the previous slide. So I've got a $1 million bond in the bond market, and it is paying a 5% yield in the money market. So really, I'm looking at the same financial instrument. I'm looking at a bond on the left-hand side in terms of the financial asset that it is. On the right-hand side, I'm looking at the same bond in terms of the yield that it is paying, 5%. Now, just so that we can really come to terms with how these markets are effectively modeling the same thing, on the left-hand side, I have modeled an increase in the demand for bonds. So an increase in the demand of bonds shifts the demand curve to the right, and the equilibrium price moves up to something higher than 1 million. Now let's think about this. An increase in the demand for bonds. Who demands bonds? Well, the people who demand bonds are people who have savings, typically. So we're keeping this nice and simple at the moment because we will be going into bond markets in more detail later in the course, but just for now we're using this as an application of demand and supply. So when the demand curve for bonds shifts to the right, it's really people or investors into the bond market, people with savings, who are driving that increase in the demand for bonds. So it's literally fund managers going into a bond market with the cash of clients saying, we want to invest our cash into the bond market. That then shifts the demand curve for bonds out to the right, driving bond prices up. Now, when that fund manager takes a certain amount of money, this would be a large amount of, we're generally talking about large amounts of money here. When that fund manager takes that large amount of money into the bond market, that person is simultaneously increasing the demand for bonds, but increasing the supply of loanable funds as well. So when you take your cash into the bond market as say a fund manager, you are supplying that cash to the bond market, and that's why the supply curve of loanable funds is shifting out to the right in the right-hand side diagram. But at the same time, you're taking that cash and demanding bonds. So you're actually driving changes in the two markets simultaneously with the one transaction. When you take your cash in, you're supplying additional loanable funds, but at the same time, you will use that cash to demand bonds. And so what we get is, on the left, bond prices increasing, and on the right-hand side, we have the yield decreasing, which was that inverse relationship that I was talking about when we went through the first slide on bonds. So what we've got is bond prices going up, and because the coupon payment is fixed on bonds, that pushes the yield down in the loanable funds market. Okay, so let's have a look at the Australian bond market. We've got a $1 million bond, coupon payment of, say, $50,000. We've got an initial yield right here of 5%. Now, let's then assume that there is an increase in the supply of loanable funds in Australia's bond market. So if loanable funds are coming into Australia's bond market, it means that people are moving money out of other asset classes, maybe real estate or shares or cash, and they're pushing this money into the bond market. As that happens, the supply of loanable funds shifts to the right, pushing the yield down. Now, to actually push the yield down when the coupon payment of $50,000 is fixed, the only way to do that is for the price of the bond to be pushed up. So if the price of the bond goes up to say 1,041,500, that will then push the yield down to 4.8%, given that the coupon payment is $50,000, which is a fixed coupon payment. Why are these coupon payments fixed at, say, $50,000? It's just the way the market operates. Okay, so that's how increases in bond prices can actually push the yields down. In the next slide, I've got the US 10-year bond market versus the Australian 10-year bond market. And what you can see is I've drawn the yield in Australia being slightly higher than the yield in America. Now, it's typically the way it works. Bond yields for a certain duration of lending, say 10 years, and a certain quality of borrower, say the government, which is generally rated AAA. In Australia, we will pay higher interest rates than in the United States. Now, there's a number of reasons for that, and I've got a list of them there. It could be reflective of a risk premium or inflation rate differentials or expected interest rate changes, etc. That's a little bit advanced, but we will come back to that later on in the course. But for now, I just want you to note that interest rates for 10-year bonds, while they're very similar across countries, they are different. And so I've got a 0.4% difference there between Australia and the United States. So in the next slide, I want to explain to you why it is that interest rates on, say, 10-year bonds are very highly correlated, particularly among developed economies. So we'll start off in the United States with a yield of 4.5%, and we'll start off with a yield of 4.9% in Australia. Then let's assume that there is a decrease in the demand for loanable funds in the United States. So the demand curve for loanable funds shifts to the left. Now, what could cause that? A decrease in the demand for loanable funds. That is typically companies undertaking less investment. Companies are the ones who demand loanable funds, or it could be the government, but there is less either investment spending or less government spending occurring in the United States. That decreases the demand for loanable funds. That then pushes the interest rate down in the United States by 0.2%. At the same time, it also reduces the quantity of loanable funds, or the quantity of lending in the bond market, from Q1 back to Q2. Now, that money, and let's assume that the US and Australia are the only two bond markets in the world, that money, the difference between Q1 and Q2, then flows into Australia. Because if that money is not being borrowed anymore in the United States, it's going to move over and be transferred to the Australian bond market. And so that's why I've drawn an outward shift in the supply curve of loanable funds in the Australian bond market. So as the supply curve for loanable funds shifts to the right by the distance Q1 minus QF, that drives the yield on Australian bonds down as well. So what you can see is that a 0.2% drop in US bond yields that occurred as a result of a domestic drop in borrowing in the United States then transferred itself to a 0.2% drop in bond yields in Australia. So it's really that international capital mobility, the ability of these loanable funds to move between bond markets internationally, which keeps interest rates in developed countries moving very closely together over time. Of course, there's always exceptions to rules. While we see long-term bond interest rates or yields moving very closely over time, for the majority of the time, there are exceptions. And so what I've got here is the case of the United States 10-year bond market, and all of a sudden there is perhaps a currency crisis in the United States. That is, investors are concerned about the United States economy. This is just a hypothetical. They're concerned about the United States economy and they start moving their money out of the United States. Well, when they do that, they would be selling their bonds to take their money out of the United States. That would actually push bond prices down, but it'll push yields up. So on the left-hand side, I've modeled this as a reduction in the supply of loanable funds in the United States bond market. So investors sell their bonds, they take those loanable funds and they move them out of the bond market, and that pushes yields up. Now, if that's the case, then the reduction, that money that is moving out of the US may actually begin to move into Australia. So what we may see is the supply curve of loanable funds in Australia actually shifting to the right, which is actually going to push the yield in Australia down at a time when the yield in America is going up. So you can actually have situations where these yields are moving in opposite directions in two countries. But certainly the most usual case is the case that I went through previously, where interest rates are highly correlated over time in developed countries. So this slide here, where there was correlation between long-term interest rates, is the usual case, but certainly